Hey everyone, welcome back to Corporate Decoder, the place where we try to figure out if a company is secretly performing a magic trick with its numbers. Today we're digging into some juicy filings that might just reveal a magician, or maybe a wizard, or perhaps just someone who misplaced their favorite accounting wand. This report, folks, is basically a company announcing something important has happened, and they need to tell the authorities like the US Securities and Exchange Commission, or the CC for short, right away. Think of it as a corporate breaking news alert. An American strategic investment company has some news that is worth unpacking. So, the big news here is a change in who is auditing their books. Their longtime auditors, PricewaterhouseCoopers LLP, also known as PwC, have been let go. This wasn't a sudden firing, it seems like it was part of a plan to streamline costs. Basically, the company is looking to cut down on expenses, and changing the accounting firm is one way they're doing it. Now, PwC has been doing their audits for the past couple of years, including the big reports for December 2023 and 2024. And good news is, their reports did not have any major red flags like a bad opinion or a tricky disclaimer. However, there was a note in their 2024 report that mentioned the company had significant liquidity constraints. Now, that is a fancy way of saying they might have been running a bit low on cash. It is always good to see auditors being transparent about potential cash flow issues. Crucially, the company states there weren't any big arguments about accounting rules or financial reporting between them and PwC. That would have caused PwC to call them out in a bad way. This is important because it suggests the change wasn't because of a massive accounting dispute. So, who is stepping in to fill PwC's shoes? It is a firm called CBIZ CPAs PC, or CBCPAs for short. They've been appointed to audit the company's books for the rest of 2025. This appointment is still pending their own checks and signing a formal agreement, but it looks like they'll be the go. Toe accountants for American strategic investment company moving forward. The report also makes it clear that the company hasn't really consulted with CBA CPAs before about any major accounting decisions or potential problems, and CBCPAs hasn't given any advice that the company relied on for a big financial decision. This is standard practice to ensure the new auditor is coming in with fresh eyes and hasn't been influenced by prior discussions, which can be crucial for an objective audit. And to make sure everything is above board, the company sent this disclosure to PwC and asked them if they agreed with what is being said. PwC sent back a letter dated the 21st of October 2025, which is attached as an exhibit. This letter basically confirms PwC's agreement with the company's statements about their departure, which is a good sign of cooperation. Now let's peek at what kind of stock this company actually has. They've got class of common stock, which essentially means basic ownership shares, and they also have something called class of preferred stock purchase rights. These rights usually give holders the ability to buy stock under certain conditions, often to prevent a hostile takeover. The fact that these are listed and traded on the New York Stock Exchange, or NYSE, means they are public companies with shares available for anyone to buy and sell. Looking at American Strategic Investment Company itself, they are incorporated in Maryland, which is pretty standard for many US companies. Their ticker symbol, that is the code used to identify them on the stock exchange, appears to be NYC. That is a bit unique for a company name like this, making it potentially easier to remember. Now, let's zoom out and consider what this all means from an investor's perspective, or even just someone curious about how companies operate. Changing auditors, especially from a big name like PwC to a less globally known firm like CBCPAs, can sometimes be a signal. It could be a genuine cost-saving measure, as the company claims, which is understandable in tough economic times. However, it can also sometimes be a sign that a company is looking for a fresh perspective, perhaps one that might be more lenient on certain accounting treatments. Or maybe they're expecting some significant changes in their financial reporting that they want a new team to handle from the start. The mention of liquidity constraints in the previous PwC report is a crucial detail to keep an eye on. It means the company needs to demonstrate it can manage its cash flow effectively. This is where the new auditors, CBAs, will really be put to the test. We'll want to see how they address this in their future reports. The fact that there were no major disagreements with PwC is reassuring, as it suggests the change is likely driven by business strategy rather than a deep-seated accounting controversy. Ultimately, this filing is a procedural step. It tells us about a change in a key function within the company, its financial oversight, for existing or potential investors. It is a signal to pay closer attention to the upcoming financial reports from CBS CPAs. We need to see if they confirm the company's financial health, and if the cost-saving measures translate into improved performance without sacrificing necessary investments or creating new risks. The company's direction, therefore, hinges on managing those liquidity concerns effectively while continuing to operate and innovate. It is a balancing act that we'll be watching closely. Alright, that is our breakdown of American strategic investment company's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out our Discord community linked in the description below. Thanks for watching, see you next time.